Hi there, good evening, and welcome to my channel, The Bottom Line. I'm going to quickly talk about the current scenarios that exist of high interest rates. We were in an era where we had about 4% interest in 2020, and we are now at a interest rate of 6.5%. Now, in high interest rate scenarios, you cannot expect your equity portfolios to grow significantly. The companies face a lot of debt challenges, growth challenges, consumption challenges, and endless amount of challenges of slowdown that they have to face. But there is an alternate strategy of what should we do when interest rates are on the higher side. So there is some sort of investment that prefer uh, with some understanding around how the bond market works, and basis that there is an opportunity that exists for one to capitalize at high interest rates. So let's quickly take a look at that. I'll explain the logic behind it, and probably in the next follow up video, I'll also take you through what investment instruments do I look into when such an strategy is required to be deployed. So, if we broadly look at the financial market as such, is that everybody is trying to put a quant strategy around. Everybody is trying to make some numbers churning and coming up with correlations of this had happened when in 2010, maybe this had happened when it was 1999, and whatnot. But like a famous investor, Charlie Munger, says, is that while everybody is looking for brilliance, they look for rationality, they look for rational around why a certain investment is going to turn out good for them. And I think that makes a lot of sense to me, and I follow that, and I try to put one thing, one ingredient that is very important looking at the kind of time that we get on an everyday basis, is that simplicity to the strategies, bringing down a lot of jargon and making it very very simple for me to understand more than anyone else as to why I'm doing or why I'm applying a certain strategy at a certain point of time in the market. So if you look at the current economic status, and this forms a very important part of the strategy deployment as to why I'm doing it at this point in time. uh, if you look at the current economic status, we're somewhere at where the yellow arrow is. It is very close, from the depression area. It is just in the phase of recession, and possibly from here, there is a likelihood, and I use that word very carefully, there is a likelihood that we would go back into a recovery phase of the economy. Now, while we are in the situation where you see the yellow arrow, is we are in that situation, and for us to be in that situation, the interest rates had to rise up. And somewhere I do believe that we are, peaking towards the highest point of the interest rates. Now, what that means is that from here, there should be no or minimal rise in the interest rates. And here, when I say interest rates, I'm only talking about the country's repo rate. Now, the strategy logic that I apply is very simple. It has to do with bond prices, and it has to do with the interest rates. And you will find this a lot of articles around it. I'd recommend you to go read it. But the simple correlation is, as the interest rates fall, the bond prices rise. And it has to do with a very simple logic that I quickly want to explain through this chart. Is, let's say I buy a bond today, and that bond is offering me 7%, because of the high interest rates that exist right now. So the repo rate is at 6.5%. The government of India says, okay, let me put a 50 basis point spread on it, and let me float the bonds out at 7%. And let's say I buy it today in some or the other form. We'll go to what instruments could we really use, but this is what it is as of now. And let's say that, according to my analysis, I reserve the right to be wrong, but according to my analysis, the interest rates have peaked, and they start reducing from here in the next couple of years. Now, when the bonds floated in the market during the time when the interest rates were higher at 7%, the new bonds, according to the revised interest rates, are definitely going to offer lower than 7%. So now imagine 2 years down the line, if the interest rates have genuinely reduced, what happens to the demand of the bond that I am holding? It is obvious that now people want to get paid 7% and not the existing prevailing rate of 5%. That puts a lot of demand into the older long duration bonds, which are providing higher interests and higher returns. And because of the demand, the price of the bond goes up. Very simple, very straightforward, and can be applied every time when the interest rates are near the peak. Okay, if we look at and if we say that every time the interest rates are near the peak, I'll deploy the strategy. I do not expect myself to have complete accuracy on how much the interest rates will go further from here. I'm open to the fact that I could be wrong. There could be situations in the world economy that make the Reserve Bank increase the rates further. But every time there is an increase, we are going to get closer to the peak. So that will be additional investment tranche from my side. Now, the government bonds are floated into the market for auction a lot of times, and most of the times we cannot really plan it, or the most of the times we cannot really time the markets. So, in that case, I generally prefer giving this investment to a mutual fund as best. And what the mutual fund does for me is it keeps the money in cash holdings, and whenever there is a government bond floated outside, they are going to have a situation where the government bonds will be bought. So, and those category of bond funds are called as long duration bond funds. Uh, I hope this was insightful. The strategy is very simple. Do this when the interests are near the peak. I'm expecting the interest to reduce from here, and I deploy towards long duration bond funds, expecting that the bond prices will increase as the interest rate falls. More to come in the next video on which bond funds do I look at. There is a category in it. Even within the long term duration bond fund, it is very important to understand what are the constituents of that bond fund, and those define the risk. So maybe in the follow up video, I'll look at the risk in the bond funds, and basis the preference, how can one decide. I generally am a fairly risk averse person, and no shame in admitting that. And I try to assess my risk even in bond mutual funds wherever I'm trying to invest. So probably see you in the next follow-up video whenever I'm able to take time and make it. But I hope this adds value, and this is very apt for the current scenario and the current time. So I would recommend you to do your own analysis, see if this fits your uh, you know style of investing, see if this fits the logic, see if it adds some value in terms of education, and do the needful. Thank you so much for taking the time to hear me out, and see you in the next one.